Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Raymond Bridges, Managing Member of Bridges Capital, to discuss active index investing to bridge the gap of volatility. Raymond, it's great to have you with us. Welcome to TradeTalks.
Hi, Jill. It's great to be here. Thank you for having me.
You got it. Tell us a little bit more about your background.
Yeah, so Jill, my background degree was in economics. I have a master's degree in accounting, certified public accountant here in the state of Florida. Started in the financial services industry a little over 20 years ago, doing everything from managed futures, client trading advisor, certified financial planner, insurance, annuities, and private banking. In 2018, I started my own investment advisory firm, left a large bank in order to give clients really the service, the fiduciary service I think they were paying for, but you're kind of limited at these large national brands. Those focus are mostly on clients' accumulation of assets, and they don't give you that risk-adjusted return or that opportunity to give clients the risk-adjusted return that you can get as an independent advisor. So that's when I started my own investment advisory firm, 2018, and have kind of refined that process into this ETF that we just recently launched in May.
How has the Bridges Capital investment process evolved over time?
Yeah, so like I was talking about, since I started my investment advisory firm in 2018, the process evolved. It's basically a macroeconomic thesis that looks at monetary policy. I subscribe to more of the Milton Friedman kind of monetary theory, where you look at money supply driving asset prices over time. So in order to get a bull market or sustained asset prices over time, you need to have an increasing money supply. Certain things fall into that, obviously the Fed policy, other things such as earnings, bank credit, lending, unemployment, things like that also lead into the money supply. And you need to have that over time. So the process looks at that monetary policy, but then also looks at a technical breadth and volatility analysis to be opportunistic based on kind of a thesis, whether it's bullish or bearish, that changes less than annual.
What differentiates the Bridges Capital ETF, ticker BDGS, from other ETFs?
Yes, so, there's most ETFs out there are passive. I'd say the large majority of them are passive. You're looking at XLP or XLE or, consumer staples, technology. The active ETF space has been growing recently. A lot of funds are flowing into the active management. One of the main reasons for that is you have tax efficiency with ETFs. So if you're active and you're managing assets, whether SMAs or if you're managing your own portfolio, the 1099s for capital gains, long-term capital gains or short-term, they have to be paid every year, right? So an ETF gives you kind of a wrapper if you're doing that management to be tax efficient, so you don't have to distribute those gains out necessarily all the time. So that active strategy makes sense in an ETF. So there's a lot of ETFs that are becoming more and more active, and we're seeing funds flow into that. Whether there's other ETFs out there that are doing my specific strategy, I don't really see anything out there that's looking at a macro thesis that changes less than annual, looking at the money supply, and then also combining that with an opportunistic strategy when you're looking at breadth, volatility. So just for kind of an example, over the past year, it was December of 2021, the thesis and the separately managed accounts turned into a bearish thesis. It's remained bearish since then. And even though it was bearish and we were holding cash for the largest percentage of time, we were opportunistic about 4 main trades last year to participate, not necessarily from the trough to the peak of each of the bear market rallies, but we were able to participate in those bear market rallies, but protect the capital on the major washouts that occurred last year based on that macro thesis remaining bearish.
Being a newly launched ETF, are there any liquidity concerns for investors?
Well, so if one of your viewers, an investment manager, somebody pulls up BDGS being launched here in May, the pricing on the chart will be sporadic. You'll see different pricing, and that might lead somebody to say, is this fully liquid? Because it's not traded every single minute of every single day. But when it comes to an ETF, you have to look at the underlying assets of the ETF, because investors don't necessarily trade directly with the ETF. They're trading with the market maker, which then buys the shares of the underlying ETF and then delivers the shares of the ETF to the investor. So by holding Apple, Microsoft, large cap equities, which is what the ETF holds, as well as SPY or even T-bills, the liquidity is not an issue. What investors need to be concerned with is that spread, between the bid and the ask, and they're paying the ask, they get the bid. And that spread with the ETF since we've been launched has been roughly 6 cents. So it's a fairly tight spread. So if you're an investor or money manager, you're looking to allocate into the BDGS ETF, and you want to put 5, 10, 15% of your equity portion into this type of strategy, liquidity would not be an issue.
And what is your current outlook for the equity market right now?
Yeah, so I guess this is really where there's the meat and potatoes, or where you're going to generate that risk-adjusted return for your investors. So there's a lot of talk out there, right? Are we into a new bull market right now, or is this just another bear market rally? We technically, just last week, we went 24% on SPY from the lows of October. So a lot of people saying we're into a new bull market. The thesis still has remained bearish. And it's not just from a technical standpoint, but you need certain underlying factors fundamentally to get those sustained prices that are higher and higher. One is the increasing money supply. So the Fed has paused, and since May, this increasing kind of liquidity or money supply that we've seen has been stemmed by the Fed changing policy, not fundamentally, but increasing, the balance sheet by roughly $300 billion to stave off this banking crisis with the Bank Term Funding Program. There was a lot of talk when that was first initiated, whether that was QE or not QE. Long term, that's probably a net liquidity draw. It's not a net liquidity increase, because it is expensive for banks to access the Bank Term Funding Program. They're paying roughly 5% on those loans. So it is expensive. So it's a net liquidity draw, most likely from the long term. But in the short term, that was an increase of roughly $300 billion when the Fed was supposedly tightening, doing quantitative tightening, as well as raising interest rates. It's helped fuel this AI rally we've kind of had. AI has been the headline where the money and liquidity has found a home and driving these prices up, but it's not necessarily long term unless there's some significant change in either earnings. We see it because S&P is now around 20%, right? And it's price to earnings valuation, so that's expensive. You can get a similar return. You can get a nice return, 5.5, 5.35 in T-bills, no volatility. So until certain things change, the yield curve's inverted, right? Hasn't been this inverted the 2 and 10 years since the early 80s. In 81, we experienced a double dip recession. A lot of people thought we were out of if you read back then, a lot of people thought we were out of the bear market, and then we had that double dip recession. The yield curve has been inverted. So a lot of funds, it's attractive when you're looking at those T-bills. So these equities need to have something else to support these higher and higher prices, whether it be a change in monetary policy that's solid, earnings, unemployment gets stronger, but I just don't see it sustaining these prices in the medium term.
All right. And Raymond, in the last minute here, how is your allocation and strategy positioned to take advantage of your outlook?
Yeah, so the allocation of the ETF right now, like I mentioned, it's long-term, right now, it remain bearish on the macro fundamentals. So when we launched in May 11th, we were about 20% large cap equities, Apple's, Nvidia's, Microsoft, things like that. We've scaled off into this rally. Currently, we scale about 10% of those individual holdings, and we continue to buy T-bills. They're attractive. You're not getting much volatility. We're holding almost 90% in T-bills, tax efficiently scaling off those gains, buying T-bills north of 5%. And if this rally continues to go on the AI with Apple and Microsoft, we'll participate in it, not until we see a fundamental rebalancing of either repricing of equities, or we get a Fed policy shift, or we see earnings sustained where we can get a more attractive PE valuation. Are we going to look to participate in this equity rally?
All right, Raymond, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you for having me.